We have the privilege to have three distinguished, experienced, knowledgeable, and reasonably good-looking commercial lenders. That's right, that's right. They are here today to impart some information, to talk to you, and so this session we want to be interactive. They're all experienced and very knowledgeable, so there's no problem if you want to ask questions during the conversation, and that's what we want it to be. We're going to talk about different styles of lending, how we approach lending to small businesses, and we want your questions to kind of generate the conversation today. So let me start off by first introducing our panel. The first one I want to introduce is the lady in the group, Ms. Carol Apicella from Sterling National Bank. You can call her, that's right. Next to her is Mr. David White from Wells Fargo. And next to him is Quasi Rogers from Federal National Credit.
Good morning, everyone. Good morning.
So let's get started with asking each of them to tell you a little bit about their organizations, and then we'll get involved with some questions and some discussion about small business. And remember, I want you to participate. So all those questions that you haven't asked your bank, ask these guys. They'll answer them. So let's begin with Carol. You want to start? But tell them a little bit about who you are. Is that on?
Your mic's probably not on.
Craig, is that on?
Yes, it should be.
Okay.
It's on. It's on. I believe it's on now. At any rate, good morning. I'm Carol Apicella. I'm with the Government Contractor and Payroll Finance Division of Sterling National Bank. And the product that we bring to the table for government contractors, or basically for any company that's providing services, albeit whether it is as a prime contractor or as a subcontractor, we bring the capital to them so that they are able to run the company, meet their biggest obligation, which typically is their payroll requirement, and also a portion of their gross profit margin, upfront in real time, even prior to invoicing, let alone being paid for invoicing. So it's a very unusual bank product, but that's what we bring to the table. I'm here in DC and also have an office in Maryland. Have been in the market a long time. And have seen many different types of varying financing availabilities. And there's something for everyone. Each of us brings something a little different to the table. And so as we continue through the morning, questions and curiosities are welcomed. So again, I'm Carol Apicella, Sterling National Bank.
Good morning, everyone. My name is David White. I'm with Wells Fargo's Business Banking Group as a commercial lender. And really this morning, it's more than just the loan piece of it. We actually look more towards a relationship. And that's really our strategy and focus. My focus in particular is in government contracting and technology, partly because of my background, having worked in both government contracting and technology for a number of years prior to moving over into the banking industry. With Wells Fargo, you get more than just the credit component of it. What we're actually looking to do is look at take a holistic approach and look at all the factors in terms of how do you meet those financial goals. And so for us, the first conversation is really around understanding your business, your needs, what are your challenges, what are you looking to achieve in order for us to tailor our financial solutions to those, because we really can go end to end. As a large financial institution, obviously in this country, we are able to provide services across the board, from payroll services as being the top #3 lender in the country for payroll services, as well as merchant, to insurance, employee benefits. So we really cover the entire gamut and can help you more than just from a lending perspective, provide access to capital, but also in helping to cost save in terms of saving on your services in terms internally. So with Wells Fargo, we do have a focus on our small business lending in particular. I'm based here out of Tyson's Corner, working on both small business to mid-sized firms. So we're able to kind of help guide you through that process. As you continue to grow, we're able to grow with you and scale up. And from there, we hope to be able to meet all your financial needs. And again, my name is David White with Wells Fargo's Business Banking Group. Thank you.
David, I just have one question. Did you bring any of those Wells Fargo piggy banks? My kids really love them. I told them you were going to be on the panel. So.
I did not.
Oh, my kids, my 3 boys are going to be so disappointed. That was reason number 1 I came here this morning. Reason number 2 is I'm with Federal National Commercial Credit. We're a small entrepreneurial finance company, And the key word there is entrepreneurial. So all of you are entrepreneurs. So every morning you get up, you look for new revenue. So I have applications in my pocket, and the doors will be locked shortly, and you won't be able to get out until you fill out one of my applications. So Federal National is an entrepreneurial finance company. We provide factoring and asset-based lending. We've focused in large part on serving the government contracting community for the last 22 years. We're in the midst of a national expansion, and as such, have diversified and are now providing financing to a whole host of industries. Typically, we're focusing on providing cash flow solutions to those companies who are anywhere between $1 million to $60 million in revenue, and who generally provide a service or provide goods to their customers and extend credit, and as such, need to bridge the gap between the time that they invoice and the time it takes for them to get paid. Furthermore, we'll also provide financing on the other assets on the balance sheet, whether they be inventory or the machinery and equipment. So that's a little bit about Federal National. We're headquartered in Bethesda, Maryland, and I'll turn it back over to Mike.
Well, as you can see, we got three lenders who are experienced, who have little different programs, little different approaches to the market. First of all, let me just see, who in here is not a government contractor? Everybody in here, oh, so a couple. Okay, what kind of business are you in, sir? Oil and gas. You're a banker. I heard about you already. You can join us. Anybody else? It's not a government contractor? I know you too. Okay.
But we provide support to government contractors who refuse to work for the federal or any government.
Okay.
That's a strong word, refuse.
Yeah, refuse, huh? You've had some good experiences,
You
Brad.
said that with conviction.
Yes, sir.
I echo the sentiment of my friend on the left there. We love to work with government contractors, but not for the government.
Not for the government itself, okay. Well, that's good to know, because even though you'll find that there's a lot of government contract lending experience here, these folks are also small business lenders. So even though you may find some of the comments to be more geared toward a specific industry, those of you who support the industry obviously are aware of the jargon and the kinds of things that go on in government contracting. For the rest of you, we're really talking about small business lending. You're going to hear later today from an SBA person who's going to talk to you about those programs. I guess I want to start with just asking a general question from our lenders. You've got a bunch of people out here, all of whom are going to sign applications for Quasi this morning, or you can't get out.
Thank you, Mike.
Yes, yes. But I guess my first question is, after you sign the application, what are the things that you would like to get from your typical applicant? What's in a package? And I don't necessarily, well, I'll let you start. And I guess I'll start with David in the middle. You tell them what's in your package at Wells Fargo, since you're the biggest guy at the table.
I don't know if I'm the biggest guy at the table, but in terms of what we look for after we receive the application, obviously, I think everyone always looks at the financials, and that is a key component in terms of us really being able to tailor the financial solution. But what's really more important, and what's the initial conversation that we always have internally with our credit officer when we're sitting down to look at an application, is really the company itself and understanding what they do, what their experience is around that, and more importantly, what they're looking to achieve, so that we can really tailor that discussion around how can we provide the best solution for that particular company, because everything is really tailored based on your particular situation. Everyone's unique in terms of where they are, in terms of the business life cycle. And so in terms of that fit, we look at that component of it. So that's a key component. The other part of that is also communication, and really having a clear understanding and a candor in terms of what they're looking to achieve and what we are able to provide to them. And if they're not quite there just yet, what can we do to help them get there? And having that conversation of how we can assist them, and whether that's providing additional resources around that, providing advice on things that we look for, we'll do those as well. But obviously, the cornerstone of that is going to be the financial reporting associated with that, so that we have a clear picture of the company and where they're going.
Okay. Carol, how about you? Anything in particular that you like to see when borrowers are approaching Sterling National Bank?
Absolutely. And also to parrot what David mentioned, the key component for me as a lender is to understand where your company has been, where it is today, and where the future is, and how whether or not Sterling National Bank's programs will benefit the client, you, or as well as us. And the most important thing for me is communication and building the rapport. So even prior to the application, before you fill out Quasi's application, the doors are locked, you're going to come and talk to me. Just kidding. Because I really want to build that rapport with you, and I want you to understand our programs as well as I understand your company. Because you know when you're in a position to either change lenders or looking for a source of or an avenue of financing to continue the growth of your company, you want to be sure you know everything about them and whether or not their product's going to meet your needs, and then vice versa, the same thing for me. And of course, the financial component, financial statements, projections, those sorts of things are important as well. Very, very important for me to make my basis as to whether or not I can offer you a structure that's going to make sense. But I think the key component is the building the rapport and the trust and understanding your business, which David mentioned, as well as your understanding our business. And of course, if you ever engage with us or with someone else, there can be bumps in the road at the beginning of the engagement. It's like going out on a first date. However, if we both understand one another and what the expectations are, then it makes the second date a little better and easier.
Dates with your banker are not allowed, by the way.
It's frowned upon in this area. Again, just to echo the sentiments that my colleagues shared, we do look at, of course, we're going to ask for the financial information. We're going to look at the financial package, and in doing that, we're going to look at, what happened yesterday, what your experiences are. But we're also we look at all that because it gives us an indication of what we can expect in the future. And then we're also going to look at the projections. We're going to look at your cash flow, because again, what's most important is forward-looking, but the past is generally a good indication of what's going to happen in the future. So after we look at all that information, then we want to hear your story. There's a story behind every entrepreneurial venture, and it's hard to know the business without getting to understand the story, without getting to know the management team that drives that business. There are generally one or two people in a closely held corporation that drive that business, that create the culture that drives that business, that motivate the employees to meet the goals and objectives of the corporation. So it's really difficult to understand and know that company until you get to know those key players in the management team. And when you get to know them, then you better understand what makes the company tick, and then you'll have a pretty good understanding of what you can expect from that company going forward.
Okay. You've heard us talk about financial packages. Let me just, for a moment, talk about what's in that package. Typically, you're talking about financial statements for at least 2 or 3 years. You're talking about tax returns, personal in some cases, business as well, projections prepared by your CFO or you if you're good at that kind of thing, as well as the same kinds of stories when you talk about past performance when you're bidding on these contracts and things. Is there anything in particular, I know that we'll hear about business plans and things like that. Anybody have a particular feeling about business plans or what they want to see, or do you like them, don't like them? Who wants to take that question first?
Well, I mean, I like business plans. They're pretty and they tell a story, but I just assume talk to the business owner and allow them to explain where they're going or where they've been, as opposed to read the business plan. So I can talk to someone over the phone. I can meet them in person. I can look at their numbers and get a lot more out of those activities than I can the business plan, because as I said earlier, there's a story behind behind every lending relationship that we have. So I think it's most important for us and the entrepreneur to listen and create a rapport with one another and understand what our needs, what our goals and objectives are. And I don't think a business plan conveys that as well as having a one-on-one discussion.
Okay. Dave, how about you? Carol, you? Either one?
Thank you. I go back to what I originally stated, which is so important, communication and understanding and building the rapport with the individual who owns the company and or their CFO at a given time, because as Kwasi mentioned, and David as well, we all have a story, no matter what the business is, whether you're a startup, whether you hit a bump in the road, or whether your growth is soaring to the outer limits. We need to understand that, and you have confidence in us, and we have confidence in you, so that we can provide you the best product. And I think that that's the most important thing for me.
And the only thing I'll add to that is just that I think that business plan is a conversation starter. It'll probably prompt more questions for us to be able to really probe closer in terms of really what your objectives are and where you're going, and how you derived at that business plan, and how you derived at that competitive landscape that you looked at, how you derived at those projections. So it's more of a conversation starter than more than anything else.
Okay. All right, so, yes, sir.
Hey, you guys know James Chris.
Yes, James.
A question. The information that I'm hearing, maybe I'm not hearing it correctly, but it sounds like it's for a seasoned company. What about a startup company, a brand new company? What do you guys take on it as far as a company that don't have that 3 years past performance in finance, don't have 3 years worth of statements, something like that?
You want to answer that first? Or you want me to?
Take it away, Pam.
I'm sorry, I didn't hear your first name.
James.
James?
James.
Good morning. Okay. Regardless of, for my product, regardless of whether you are a startup or whether you are a seasoned company or whether you have been in a startup mode, maybe motoring along at a minimal revenue rate and then have the ability to grow, and you need to have financing to support that growth, that's inconsequential to us. You may not have 3 years of financial statements. You may only have 1 year. You may just have started up this year. That's fine. The key component is, for us, do you have the ability to sustain your business? We'll provide the capital so that you can do so, and do you have the contracts to be able to go forward? That's the key for my product. And for others, I'll let them speak to themselves, but that's where we are. We definitely are from startup to approximately 150 to 200 million in revenue. So there's a large growth potential there on my canvas. And if it's anything larger than the 200 million mark, then typically I'm going to do a syndication and participate it out with other lenders with whom we are comfortable. As those I am with at this table as well. So to answer your question, yes, startups definitely not a problem at all, truly.
So given that, we are an entrepreneurial lender, our application is, fairly standard, and it has all the, we ask for all the standard information, but I always tell prospects who are startups, if something's not applicable, that's part of your story. Just tell me it's not applicable and tell me why. And if it makes sense, then we'll continue to move forward. For instance, if you're a startup, you may not even have 1 year's worth of financials. You may just have this year's, and that's fine. You're not going to have last year's tax return, and that's understandable. But neither of those examples are going to prohibit us from moving forward. So again, it's about understanding the story and the circumstance, and customizing a solution that is a fit for that particular prospect. I hope that answers your question.
Dave, how about Wells Fargo?
I figured we want to discuss Wells Fargo as the large bank in the room here in terms of small businesses and obviously startups. First and foremost, I'll say that we do have a solution around startups and businesses that have been in less than 3 years. Because one of the first questions would be is, well, how long have you been in business? Is it just a year? Or you just started yesterday? I will say, however, that for my group, I do not do startups. We are looking for you to at least be in business for at least 2 years in the business banking group that I come from. But however, we do have solutions around those that are in the startup mode and product sets around that to support those startups that are coming out there. Because the reality is, with the bank, we're looking at certain criteria, and we need to have something from a past historical standpoint to look at. When you're looking at traditional lending, you are looking historically versus forward, as some of my other colleagues may look here on this panel here. So I would say, yes, we have something, that solutions there. It may not necessarily be in my particular division, but we do have a group that does provide that support and around that for a startup and getting them there and starting establishing that relationship with Wells Fargo as they grow. Because depending on what your needs are, because again, it goes back to assessing what are really your needs in terms of at a startup mode. Do you need a line of credit, or do you really need some form of Visa or other types of credit facilities available to you? And we have programs around that as well.
Okay. Go ahead, please. Go. Yeah, go ahead.
I just want to give you an example of something that can work very well among us as three varying types of lenders. 2 years ago, I presented this example previously, but 2 years ago I brought a client on board who had just started his company within the last 12 months, and he was billing about $32,000 a month in revenue. And he had his wife, his next door neighbor, and himself were working on this contract. And he was a small government contractor. And he needed, because he had won an additional contract, he needed financing to be able to facilitate bringing on 6 new employees. Now, he was referred to me by an incumbent bank in the area, someone that, in fact, is a competitor. So at that point, what we were able to do was provide him the working capital. And he's like, Carol, that at that point in time, we were going over the fiscal cliff. We were going to continuing resolution, kicking the can down the road, and my goodness, the sky is falling. He said, I don't know if I can go forward with you, because if I don't get the task orders, then in fact, I might have to go and become an employee of someone else, because I have a wife who works for me and 3 children, and I've got to support a family and my home. And I said, well, that's not a problem. We'll mitigate your minimum fees. If you don't go forward, we're fine. Month later, he called. Task orders were out. 6 people he had to bring on board by the end of the following month. However, at this point in time, here we are 18 months later, a little over 18 months later, and he's billing over $1.2 million a month. And he approached me and said, I think what I'd like to do is migrate back to a more traditional facility. Well, now he's got enough history under his belt. He's migrated back to the banker that actually referred it to me at that point in time. So it can be a win-win. If in fact a very large contract comes up that may be outside of the realm of the line of credit that his present bank is provided to him, he'll come back to us, we'll carve that portion out, or again, start financing his company. So it's very flexible. We work well together, I think, with other colleagues in the industry, and that's the key component for me. If it isn't working, or if you need something else, then I need to be able to understand that so I can refer you to David or refer you to Quasi, and vice versa. So just
Mike's
an
a lender
example.
too, just in case you wonder.
And to Mike, too.
Go ahead, David.
Yeah, just to add to that, I think that's true. I think any banker, that you come in contact and develop a relationship with, one of the things you do want to see out of that banker is their ability to not just say, no, I cannot help you, but what are other means? Because we do have relationships with others within the industry where we're able to refer people to other connections that we have in terms of other financial providers to really meet the need that you have, because maybe we're not able to meet it, but we have these contacts that we're able to provide to you. And the other part of it too is, from a startup standpoint, we also have our SBA side of the house where we look at from an SBA lending, because maybe you don't have the liquidity or the down payment to get started, but with the SBA, we're able to provide that financing for you.
In short, my colleagues are saying that the lending business is very incestuous, and I concur vehemently with their comments. But that's not a bad thing, because the lender that you're in front of, he probably knows, at least 100 other lenders that have very varying focuses. And so he or she is going to be in a much better position after hearing your story and understanding that it's not a fit for he or she, but it's a fit for David, but it's a fit for Carol. We'll just most lenders are more than happy to make the introduction, because in large part that's how most of us are introduced to many of our new clients. It's through introductions through the network of lenders. So don't hesitate if you do hear a no, or you do sense that the lender you're speaking to is not a good fit for you at that time. Get an understanding of why. Get an understanding of what you would need to do to qualify for their programs in the future. But most importantly, ask for an introduction to a lender that can help you, because you're in front of that lender probably because you have borrowing needs right then and now. And if you can't take care of the short term, there'll be no long term. So you need to take care of the short term in order to meet your long term goals.
Most of you are entrepreneurs, I gather. I don't think we probably have many publicly traded companies in the room. Are there any public companies? Okay. How important for you lenders is the individual or individuals that run the company? What about personal credit and that kind of thing? How does that play in your decision making? Don't all
Speak up at once. So we pull personal credit of all of the owners and key members of the management team. However, obviously every credit report comes with a credit score. And I can always tell if we've pulled credit and it's not stellar, that it's usually sitting on my chair upon my return back to the office to review. But that being said, we're not making our decision on a credit score. And so what I mean by that is I'll go back to something I've said a few times during my remarks this morning. We are story lenders. So there's a story behind every lending relationship, to include the owner's personal credit. For instance, earlier this year, we closed and embarked upon a relationship with a company, whereas the owner probably has a credit score in the low 500s. My credit team was sort of looking at me, scratching their head, and so I went through the credit report, and I called the owner. We made an appointment. He came in to see me, and he explained every blemish that existed on his credit report. And in every instance, it was really a function of just life happening. His plans didn't work out the way he anticipated, and as a result, it had an adverse effect on his personal cash flow, and as such, he was unable to meet his obligations. He was still in the process of making good on all of his commitments and was able to demonstrate that. So with that, what that tells me is that, if we hit a bump in the road in our relationship, he's not going to throw me the keys and say, "Here, best of luck getting your capital back. It was nice doing business with you, Quasi." No, he's going to sit there and he's going to look me in the eye. He's going to tell me what happened, and we're going to work in a collaborative nature in order to solve the problem. So that's what I'm looking for when I pull personal credit. Now, on the flip side, if I pull personal credit and I look at the blemishes on the credit report, and it's someone who wouldn't even pay back his own mother, then I don't. Life's too short. I don't want to enter into that relationship because I can't sleep with one eye open every night, and it's just we're not the lender for that, and that's not the borrower for us. So that's sort of how we look at personal credit, and again. One of the reasons we pull the personal credit is because, as I mentioned earlier, in a closely held company, those individuals you're pulling personal credit on, they're creating the culture. They're the driving force behind the company.
Quasi, I think you've covered a majority of that. What I will echo behind that is that is a critical component for us when we're looking at that as a part of this equation. And much like Quasi, we are going to go back, though, if we see something there, to understand what caused that, because there's a variety of reasons why your score is to where it is today. So we're also going to look at that and take that into account in terms of where you are from a credit score standpoint. So it's not the end-all, be-all, but it is a barometer for us in terms of how you govern yourself on a personal level. Is how are you governing that company as well, because you as the entrepreneur are that company in essence. And so we want to make sure that, okay, what you're doing personally can translate into what you're doing with the business. However, with any credit report, there are going to be certain things on there that may be out of your control, or things that have occurred that you're able to explain. And if we're able to understand that story behind it, then we in turn can be that advocate for you and be able to explain, okay, here's why they are where they are in terms of their credit report, and here's why we believe we should be able to move forward with this particular opportunity.
Gary, you want to add anything to that, or you?
Just one other thing I think that is important, and again, in building the understanding and the communication and relationship, if there are some issues, because obviously as lenders we are going to pull your personal credit, if you know of anything up front, just disclose it. Not that it's going to change anything when we pull a report, but it is going to help us understand, again, as Quasi mentioned and as David mentioned, that issues do occur. Many times when you are in an entrepreneurial scenario, sometimes your cash flow, as Quasi mentioned, on the personal side can be squeezed, and so those kinds of issues can be reflected. But a personal credit report is not a reflection necessarily of the individual in total. So it's a variable we look at along with many other variables as to whether or not we want to engage and make an offer to the prospective client.
So I think you heard that. You just say one thing, and then before Quasi
Yeah,
says anything.
to Carol's point, you'll save a lot of time by being forthright. You know, if you know of any blemishes, whether it be on your personal credit, we also pull background checks on the individuals, the owners and senior management. It's best to bring that up right away. I'll tell you a story about a prospect we had who said, well, Quasi, I need to let you know I have a couple blemishes on my credit report and background check. I said, well, you know, what kind of blemishes are we talking about? Excuse me. And one of the blemishes, quote unquote, was embezzlement. So I said, well, I have to be honest with you. I can't underwrite this deal. I was like, he's like, you can't? I was like, no, I can't. I was like, you know, we have a senior lender, and if it goes bad, someone's gonna ask me, so walk me through your thought process here, Quasi. I also have partners in a board of directors. I could just see sitting in that meeting. Please tell me what you were thinking, Quasi, when you decided to approve that loan. So I immediately said, no, not for us, but I tell you what, I can make a referral. And he was shocked. I heard silence. I said, do you want me to refer you to someone? He's like, about 5 people have turned me down as a result of this. Who are you going to send me to that's going to approve my loan? I said, well, there is a company that specializes in providing financing to individuals who own companies that have prior convictions. And he was floored. And so he called me up later, and he says, the money is really expensive, but I guess it's more expensive than not having it. So I appreciate you making a referral. So he was able to save some time. I was able to get him to the right lender for him, given the circumstance.
I suspect most of you are not embezzlers. Go ahead, Alberta, please.
Speaking of expensive, there's a huge difference, is there not, in terms of the lending interest rates as it pertains to each one of your companies? For instance, factoring typically charges much more on a loan versus, let's say, a Wells Fargo or Sterling, is that correct?
Well, I'll have to tell you, and David can correct me if I'm mistaken, but the largest factor in the room happens to be Wells Fargo.
But we offer the lowest rates.
Clarify that for
I'm
us,
not.
please.
I'm not trying to throw David under the bus. I'm just.
Okay.
But they.
Clarify that for
But
them, please.
but my point is, just because you hear the word factoring doesn't mean it's necessarily expensive, because it is very much the case that if you qualify for Wells Fargo's factoring group, you're going to probably have one of the most cost-effective factoring products around. And in some cases, what I've seen is their factoring product, in some cases, is more cost-effective than what you may find in a traditional banking product. But let me speak to your comment just for a second. So this is about understanding, the best lender for you, and understanding a little bit about that lender. And what I mean is, so if you're with an entrepreneurial finance company, you can probably bet that my cost of capital is higher than Wells Fargo's. And you can probably bet that my cost of capital is higher than Sterling National Bank. And let me explain why. So if you take a banking institution, their cost of money is what it costs for them to take in your deposits and lend them out. That's their cost of capital. Now, they do have some cost, and they can generally lever up 10 to 1. So they have 10 borrowed dollars for every $1 of equity. So an entrepreneurial finance company, so we have our own equity, and then we generally go to some sort of senior lender that will allow us to lever up at 4 to 1, but we have to pay for the money. So the cost of capital is higher, right? And then if you were to compare factoring or asset-based lending to a traditional line of credit, the monitoring is a lot more labor-intensive in factoring and asset-based lending, just by design. I mean, generally, factoring and asset-based lending, we are providing financing to borrowers who are more riskier than those that you'll find in a traditional banking program. So if you look at the two highest costs to provide financing, they are cost of capital and labor. So if those two components are always higher, then their cost to offer the program is also going to be higher. So if you're talking to, depending on who you're talking to and whose program you qualify for, you need to have an understanding of how they're structured and how that may affect the cost. Did that help? Did that answer your question at all? What part is the no?
No, because I wanted to hear what Wells Fargo and the other lady.
Oh, okay.
Let your colleagues talk. We will listen to your scenario. We want to hear.
Oh, okay. I just wanted to mention also, too, that when we're talking about whether it's Sterling National Bank, whether it's Wells Fargo, whether it's Federal National, the important component is this. Is the structure that you're going to receive from that lending institution going to meet your needs? Because in traditional banking, remember, the depositors are the most important to the bank, period, all banks. And there are going to be covenants and restrictions that can come along with a traditional facility that may not come along with what Quasi may offer, or maybe what the division of my bank may offer. So for instance, in two verticals, if I'm offering a traditional line of credit, there's going to be covenants and restrictions, maybe debt to equity, there's going to be revenue, probably covenants, but perhaps in the government contractor and financing division that I'm in, the most important and key component is providing my client with the capital so they can run their company. So depending on what's going to make the most sense, at some stages in a company, it makes sense to use the correct program, because if you're starting up, do you need a lot of covenants and restrictions tying you up so that you cannot grow? Or perhaps you go in and secure a line of credit maybe at a $250,000, just for an example, level, and you historically roll along for 2 years at that level, but now a large contract comes along, you don't qualify for an increased line, say to 750, because you haven't historically operated at that level, revenue-wise, or maintaining the equity in the company to qualify for it. So is it going to make sense what the program is? It's not necessarily the cost. If it gets you from point A to point B, then at that point you can maybe look to another type of financing as well. But that's the key element. Is it better to have the capital? There is a cost of all capital, no matter whether it is a bank or whether it is a commercial finance organization. And so I think that's the most important thing that a business owner really does need to look to. And so, David, do you want to comment?
Sure, certainly. I'll comment on that. Since Quasi threw me under the bus there on the factoring side. Actually,
That was an advertisement for Wells Fargo.
I appreciate that.
It is a
But
very large factory group.
it is a very large factor, but and I'll kind of talk a little bit about her scenario that she just mentioned a minute ago as well, in factoring that in. But in terms of your question of interest rates in the various, whether it's more costly from a factoring standpoint from Quasi's area versus more traditional lending, yeah, there is a difference. A traditional loan or a line of credit is going to be much lower than what you would receive at a factor. Our factoring group of capital finance is focused on the government contracting side. So one of the scenarios there, it is much less than if you went to a traditional factor. We're going to have more rates. Our rates are typically more in line with what you would get with a traditional line of credit. And I can say that just because I've done a couple of those recently where we've taken someone into our capital finance side, and the rates have been comparable to what we do offer on our traditional side. However, on that side, it is a little more intensive from a reporting standpoint in terms of what they're looking for from you and your ability to report on a monthly basis to allow for you to be able to utilize that line of credit on the capital finance side. But in terms of that scenario, when you look at what you have on the traditional side, so if you have a traditional line of credit, the way we work hand in hand with our capital finance and factoring group is that if you come across a much larger, a significantly sizable contract of 25 million to 30 million, and you're going to be scaling up immediately, whereas you may have to go out to a factor or go somewhere else. Within Wells Fargo, we're actually able to take you out of that traditional line of credit and provide and bridge you over to our capital finance group because they're looking for those high growth government contractors. And so if you are getting a significant contract where you are going to need upfront financing, they have the ability to scale to that for you. Whereas maybe the traditional line of credit may be confined because of where your past trends were, our capital finance group looks forward. So they're looking at your forward growth. And so if you come into a sizable contract, they are able to bridge that gap and actually afford you a much larger line of credit. And they typically start at $2 million and up on that side from a line of credit perspective.
Albert, please tell us your story.
Scenario.
Okay, so the scenario is this. I listened to this young man ask the question about actually small businesses getting money from
Startups, you mean?
startups getting money from banks, et cetera.
Mm-hmm.
Okay. I worked for a company for 5 years. The first year, I worked as the president of the company for 5 years. The first year, the company's revenues was small business. Then within the first year, they got a large contract. Okay? That large contract would have put them, let's just say somewhere around $7 or $8 million for the first year.
Yeah.
There was not a bank or factoring company at the time who was willing to take that company on only because they could not show true past performance, meaning that they were never going from $20,000 to $7 million. Okay?
Is this a current scenario or is this in the past?
I was going to say, we have, right.
So he wants you to fill out that application now. SBA.
contractors. So eventually, there was a factoring company who eventually took on the
That-
receivables.
right.
And was willing to allow that company to be able to come under their umbrella and then basically say, yes, I'm willing to take a chance on you. So it's not, I said that basically to say that it's not always easy
Yep.
for small startup companies to get loans. I've been on both sides. I've seen it that way, and I've seen it where literally just starting out with zero revenues, credit score 700, 800, and you still cannot get a loan because you can't show past performance.
That's a very good point. Let me just interject, if you don't mind. I would say this, and I'm not sure how many years ago it was, and I wish I had known you then. Kwasi, you might feel the same way. But the important thing is that there are lenders out here. We are a publicly traded bank, and yet we have a program that will start with a startup. Kwasi will do a startup, provided that, I'm not speaking out of turn, though, I presume.
You are correct.
Okay.
You are correct.
And then I have traditional products as well. David has more traditional products. And I think he made reference to the Capital Finance Division of Wells. And of course, there's certain levels where they're going to commence. So if you need startup capital, if you need financing for your company, there are lenders out here that will. And that's what we are up here to do, is to talk about what we can provide to you, which is we want to finance your companies.
Right, and I'll just say just a couple of quick things here. In terms of that, I think you're absolutely right. That is a challenge, and I think one of the distinctions we do have to make, though, is it bank financing that you're looking for at that early stage, or is it patient capital of equity? Because we as a bank, as a highly regulated entity, we're only, in terms of where our upside is just on what you pay us back, that's it. Now, an equity person, putting equity in, they have all the upside of you growing as a company. And sometimes it's really patient capital or equity injection that you need at that early stage versus traditional banking. I know it's always preached, from college and on up, that you go to the bank, the bank's gonna provide you funding. And then when you got into the reality of the real world, you go to the bank and say, okay, I need this money, I've just started this business. And they say, well, we really need you to have some experience and have some past performance, because we are looking backwards. We're looking historically, and that's how our approach is, that we have to look historically versus where you're going. If I was a private equity or a venture capitalist or an angel investor, then I can look forward and say, okay, I want to know where you're going. I'm not worried about the losses you've had in the past or that you're just starting out, because I'm going to invest in this company, and I know that my equity stake is going to grow, and I'm going to grow with you, and I'm going to benefit from that upside. Whereas a traditional lender, we're looking historically, because we have to judge on what have you done in the past in order to get there, or will you be able to repay us back what you borrowed?
Yeah, I guess let me just make a couple of comments. First of all, I think one of the important lessons is you didn't let us stop you. You continued. You're going to get turned down. I mean, we're businesses. We make business decisions just like you make business decisions. And in many cases, those decisions are based on our internal metrics, what we have to meet. They're also based on kind of your presentation. And in many cases, you're going to have to look and find the right partner. Part of this is that these are institutions, but these are three lenders. You want to find three lenders. You want to find commercial lenders who are interested in what you're doing. And if we say no, don't let that stop you. Many of you will borrow on credit cards until they won't give you any more credit cards. Keep going. Borrow from uncles, aunts, friends. Keep going, because your businesses will evolve. And as you've heard now, we got to go through cycles. We are a heavily regulated business. And there are times when they kind of want us to make loans, and there are kind of times when they don't want us to make loans. And so we're a federal contractor too, particularly the banks. Kwasi is not, but he gets influenced by the banks because he gets money from the banks. So from that standpoint, this is an interactive process. And just as we had those kind of questions, we want to hear more of those kind of questions. What are the challenges that you're finding out here? Right now, all of us have plenty of money to lend. So we want to make loans. That's how we make money. That's the business we're in. But we also have to get paid back. That's also the business we're in.
If I can comment on your point for another second. I'll say relationships help. So if you have a relationship with a lender before you need the money, it's a lot easier to get the money when you need it. If you can call and pick up the phone and say, "Hey, Quasi, it's me," because I had a customer who was a former customer in a different life, and he's a startup. He had no information. I mean, he did have a story. He did put together projections, but 5 years ago he was a customer, and he's doing business with other people I know. So he could just pick up the phone. I said, "Yeah, come on in. I'm here. Whenever you get here, I'm here." And you know, he told me the story, and you know, a week later we were in underwriting, and you know, a couple weeks later, you know, he had his money. That was based on the relationship. So it's a lot easier to get money, even if you find yourself in a tough position where you know you're growing and it's hard to convince someone to take a chance on you because you don't have the past history of performing on contracts of that size. If you have a relationship where someone has confidence in you, then that goes a long way.